module is to understand the different employment types in the US, to learn how to calculate pay rate, and to understand the US tax terms. First, let's look at a few important definitions, starting with employer. Now, an employer is a person or institution that hires employees or workers. Employers offer wages or a salary to the workers in exchange for their labor or work. Then we have wages. These are also called hourly rate or pay rate. Wages are paid by the hour. That is, they're paid for all hours worked, including overtime. In the US employment structure, wages are paid to an employee who's enrolled on a contract basis. Then we have salary. This is paid or calculated in terms of monthly or annual compensation. It's paid to an employee who's enrolled on a permanent basis. We have payroll. In a company, payroll is the sum of all financial records of an employee. It includes salary or wages, bonuses, deductions, etc. There are three main types of employment in the US. We have permanent employment, contract employment, and contract to hire employment. Let's look at these in detail. Starting with contract employment. We'll learn about contract employment with the help of the diagram on the right. In contract employment, the employer is the staffing agency. So the candidate is on the payroll of the staffing agency. The candidate works on the end customer's project, usually on site. The staffing agency, being the employer, keeps a track of attendance and the hours worked by the candidate and then sends the end customer a bill. This bill is calculated based on the amount of hours worked by the candidate multiplied by the agreed bill rate. So the end customer pays the staffing agency an hourly bill rate for every hour that the candidate works with the end customer. Over here in the example, we see that the end customer pays the staffing agency an hourly bill rate of $100. The staffing agency then pays the candidate an hourly wage. This is called pay rate and is agreed upon before the employment of the candidate. Over here we see in the example that the staffing agency pays the candidate a pay rate of $65 an hour. Staffing agencies may keep a markup margin of anywhere between 15 to 60% of the bill rate. In simpler words, we can say that the staffing agency may keep a cut of the bill rate. In this example, we see that the staffing agency keeps a markup margin of 35% of the bill rate. Let's look at a few formulas. To calculate pay rate, we subtract the markup margin from the bill rate. So pay rate is equal to bill rate minus markup margin. Markup margin is equal to bill rate minus pay rate. And bill rate is equal to pay rate plus the markup margin. Then we have permanent employment. Again, the diagram on the right will help with explaining this employment type. This is also known as direct hire employment, since here the employer is the end customer and the employee is directly on the payroll of the end customer. If a staffing agency places the candidate with the end customer, they get 15 to 20% of the candidate's annual salary as a one-time placement fee. So if the candidate earns an annual salary of $100,000, the staffing agency, after placing the candidate with the end customer, would make a placement fee of between $15,000 to $20,000. Let's look at a few important facts regarding placement fees. The placement fee is not always paid immediately. They may be paid 1 month after the candidate joins. Alternatively, the placement fee may be split into two parts, 50% paid after the first month and 50% paid after 3 months. If the candidate leaves the end customer within a specified period, such as during the first 3 months, and the end customer has already paid the staffing agency a placement fee, then the staffing agency needs to give them a free replacement. Let's look at the differences between contract and permanent employment. Now, in contract employment, the employer is the staffing agency, whereas in permanent employment, the employer is the end customer. In contract employment, the candidate is on the payroll of the staffing agency, and on permanent employment, the candidate is on the payroll of the end customer. In contract employment, the candidate may or may not get benefits from the staffing agency, whereas in permanent employment, candidates do get benefits from the end customer. On contract employment, the candidate's timesheet is maintained by the staffing agency, and the candidate gets paid an hourly rate, usually every 2 weeks or twice a month. In permanent employment, the candidate's attendance records are maintained by the end customer, and the candidate gets paid every 2 weeks or twice a month based on an annual salary. In contract employment, the candidate works with the end customer for a temporary period. The contract duration could be anywhere between 1 month to 24 months. Whereas in permanent employment, the candidate works with the end customer on a permanent basis. In contract employment, H-1B and E-3 visa holders and TN permit holders as well may be considered for contract positions, unless otherwise specified by the client. In permanent employment, end customers usually look for permanent residents. Therefore, H-1B visa holders, E-3 visa holders, and TN permit holders are usually not considered for permanent positions because these positions tend to be long-term, and people staying in the country on a temporary basis are not staying in the country on a long-term basis. In contract employment, while looking for candidates for contract employment, stability may not be a factor Whereas in permanent employment, stability is a very important factor because companies or the end customer wants somebody who will stay with them on a long-term basis. Then we have contract to hire employment. This is also known as direct to hire, or more commonly as C2H employment. In C2H employment, the candidate will be on a contract for a specified duration, after which the end customer can either hire the candidate on a permanent basis if they choose to, or simply end the contract. Let's look at an example where the candidate is on a 3-month contract to hire position. For the first 3 months, the staffing agency acts as the employer, receives a bill rate from the end customer, and then pays the candidate a pay rate. After 3 months, if the end customer decides to hire the candidate on a permanent basis, the candidate will be on the payroll of the end customer and receive an annual salary that will be paid out bi-weekly or monthly. The staffing agency receives a conversion fee. It's a one-time conversion fee which can be 0 to 15% of the annual salary. Now, only if the end customer likes the candidate will the candidate get hired permanently on their own payroll. A conversion fee is paid only in some cases. This is agreed upon beforehand. The conversion fee is reduced depending on how long the candidate works as a contractor before getting hired permanently. The longer the contract before getting hired permanently, the lesser the conversion fee. Then we have the conversion of pay rate to annual compensation and conversion of annual compensation to pay rate. Often, candidates working on contract positions do not want to work as permanent employees and vice versa. But if you have an attractive offer, candidates may be willing to switch their employment from permanent to contract or from contract to permanent employment. Candidates may enter both the pay rate as well as the annual compensation, or only the pay rate, or only their annual compensation expectations on job boards. So if you're working on a contract position, but you find a candidate with annual compensation mentioned on the job board, you need to convert the candidate's annual salary to hourly rate. Or if you're working on a permanent position, but you find a candidate with hourly rate mentioned as their expectation on the job board, then you will need to convert the candidate's hourly salary to annual compensation. Let's learn about how this is done. Now, what would be the equivalent annual compensation for a pay rate of $67 per hour? Let's learn about this by going according to the basics. So the number of hours worked per year is equal to the number of hours worked per week multiplied by the number of weeks worked per year. So considering that the number of hours worked per day is 8, we multiply that into 5 working days of the week, which equals 40 hours per week. A year has 52 weeks, but most American companies provide 2 weeks of vacation to their employees, which means that the employees work 50 weeks per year. Now 40 hours per week into 50 weeks equals 2,000 hours per year. So looking at the question again, what could be the equivalent annual compensation for a pay rate of $67 per hour? To determine the annual salary, simply multiply the pay rate, that's $67 per hour, into the amount of hours per year, that's 2,000 hours worked per year. In this case, it will be 67 into 2,000. 67 is the hourly pay rate, and 2,000 is the hours worked per year. That equals to $134,000 a year. Similarly, you can divide the annual salary by 2,000 to determine the hourly pay rate. And remember, these figures are approximate figures, since candidates are paid for the hours they work, which can vary. Next, we have taxes. Under this, we've got W-2 and 1099. W-2 and 1099 are tax forms that are filed with the US government. Let's learn about these two with the help of a few differences between the two. In W-2, the employer withholds taxes from the employees and pays it to the government. In 1099, the employee pays and files their own tax and tax returns. W-2 is applicable for permanent employees and contract employees on the payroll of a staffing agency. 1099 is applicable for independent contractors, self-employed consultants, or contract employees working on a 1099 basis with the staffing agency. We also have corp to corp. This is also known as corporation to corporation, or simply C to C. It is the tax form that is filed when the end customer or staffing agency pays another corporation or an incorporated individual. Let's look at these in detail with the help of a few diagrams. Now in figure 1, we see that the end customer pays the staffing agency a bill rate, and the staffing agency then pays the candidate a pay rate after withholding tax. So that's pay rate after tax deduction. This is called W-2. In figure 2, the end customer pays the staffing agency a bill rate, and the staffing agency then pays the independent contractor or self-employed consultant a pay rate without deducting tax. This happens when the independent contractor or self-employed consultant is on a 1099 contract. In figure 3, we see that the end customer pays another corporation or an incorporated individual a pay without deducting tax once again, and in this case, the corporation or incorporated individual is on a C to C or corporation to corporation tax basis. In the staffing industry,
Corp to corp is the tax term generally used by H-1B candidates where the sponsor company acts as their employer. The staffing company finds and presents the candidate's resume to the end customer. Let's look at a diagram to depict the same. So we have the end customer paying the staffing agency a bill rate. The staffing agency then pays the H-1B candidate's sponsor company a pay rate, and in this case, they don't withhold tax. So the sponsor company is on a C2C basis with the staffing agency. The sponsor company, acting as the H-1B candidate's employer, then pays a pay rate to the H-1B candidate after withholding tax. US citizens, green card holders, and EAD holders can work on a corp-to-corp provided they are associated with a different corporation. This corporation can be their own company, in which case they are called self-incorporated individuals. The diagram on the right shows us how the end customer pays the staffing agency a bill rate. The staffing agency then pays the candidate's own company, that's the candidate's corporation, a pay rate without withholding tax. So it's not on a W-2 basis, it's on a C2C basis. Let's look at how 1099, C2C, and W-2 are different from each other. Now we already know that in W-2, the employer withholds taxes from the employee's compensation. In 1099 and C2C, the employer doesn't withhold taxes. So let's learn how 1099 and C2C differ from each other. Now, using 1099 doesn't require a contractor to set up a corporation, which can involve a lot of fees and tedious paperwork. In C2C though, the contractor does need to have an LLC set up, that's limited liability company. In 1099, the employer pays the contractor directly. In C2C, the employer pays the LLC. The contractor then pays themselves a salary from the LLC. In 1099, the minimum wage law doesn't apply, and contractors must pay both self-employment and income tax on their own. In C2C, the contractor, in effect, will also be paying both employer and employee taxes as an employee of their own company. Finally, a brief word on how both 1099s and corp-to-corps differ from full-time W-2 employment. The main difference is benefits. Full-time employees are usually offered healthcare benefits, workers' compensation, disability, and paid vacation, while contract workers are not. Though, if you do set up a corp-to-corp, you can set up your own paid vacation any way you want and set up your own healthcare benefits. Let's look at a few additional terminologies. Firstly, we have prime contractor, also known as prime vendor. Companies may outsource some or all of their hiring process to one single vendor. This can be their prime vendor. The prime vendor takes on the responsibility of handling other staffing agencies as well. Tier 1, Tier 2, and Tier 3 vendors. Tier 1 vendors get to work on new requirements exclusively before the requirement is distributed to Tier 2 and Tier 3 vendors. Tier 1 vendors get to work on more requirements and the best requirements first. Sponsored candidates. Candidates who need an employer to sponsor their work permit, example H-1B candidates, are called sponsored candidates. Full-time employment, also known as FTE. Candidates work on a full-time basis for a permanent or contract position. Part-time employment, also known as PTE. Candidates working on a part-time basis for a permanent or contract position. Working more than 38 hours a week is full-time employment, and working less than 38 hours a week is part-time employment.